It is the 9th of May 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the NASDAQ and also the S&P 500, and I am going to be breaking one of Hurst's principles by considering a peak synchronized analysis in the stock markets. But before we start breaking the rules, let's take a quick look at what happened last week, and this is the S&P 500. As you can see, on Wednesday of last week, price came up to the 20-day FLD and just tapped it, found resistance at the level of the 20-day FLD and dropped down again. Several of the Hurst cycles analysts on Twitter pointed out that this is what is called a double GH category interaction, and full marks to them for identifying that. Sometimes we experience a double GH category interaction. As you know, we track a sequence of interactions between price and the FLD. We label those interactions from A through to H. And in some situations, we do experience a double GH category interaction. It's a rather dangerous moment when that happens, because it always occurs, of course, when we are expecting an 80-day cycle trough to form, at which point price rises up to the 20-day FLD and then finds resistance there instead of crossing above the 20-day FLD. If you are an experienced Hurst cycles analyst and trader, you know to look out for this kind of situation, because it is a particularly dangerous one when you are expecting an 80-day cycle trough to form and price comes up to the 20-day FLD, and instead of crossing over it in the expected A category interaction, it forms a double GH category interaction. I want to provide you with a few tips in terms of avoiding this kind of situation. There are 3 points that I would like to make. The first one is this. In the past few market updates, I have pointed out the fact that the markets are turning bearish, and the shape of the current 80-day cycle, I have mentioned in the past 2 market updates, is a mixed and potentially fairly bearish 80-day cycle shape. Why is it potentially bearish? Well, as of last week, we had experienced an only slightly lower trough as a potential trough for the 80-day cycle. But very importantly, as I have pointed out in previous market update videos, the peak of this cycle occurred early. When a peak of a cycle occurs early, it means that it is a potentially bearish cycle. That's a really important point to make. And so the first pointer in terms of avoiding this double GH category situation is the fact that the cycle shape was already fairly bearish. When you have a bearish cycle shape behind you and you are anticipating the formation of the 80-day cycle trough, you should be very careful about jumping into a trade when price rises up to the level of the 20-day FLD. That was a potential A category interaction, which should have indicated the beginning of a long trade. However, with a bearish cycle shape behind you, you would be very cautious about jumping into that A category trade. The second point that I would like to make is one that I have made in previous market update videos, which is that catching the A category trade can be difficult. And particularly when you have a bearish situation, you need to avoid jumping into that A category trade. As I've mentioned in previous market update videos, I prefer to let the market show me that an 80-day cycle trough has formed by waiting for it to cross the 20-day FLD, at which point I would have missed the A category trade, and I would rather catch the long trade when price comes back down to the FLD and finds support. In that case, of course, I would be entering for the C category trade. And so the second point that I wish to make is that it is often worth missing the A category trade because of the danger of the G and H category, or the double G and H category interactions, which can occur particularly in a bearish market. The third and final point that I would like to make about this situation is the time of day at which price actually reaches the 20-day FLD. I've spoken about this in a previous market update video, but just to reiterate, when price reaches the 20-day FLD towards the end of the trading day, in my opinion, you need to be careful. This is one of the reasons why I don't think it's a good idea to set automatic stop entry orders, particularly for an A category trade in a bearish market. If you go back and take a look at the price action on last Wednesday, you will notice that price in fact only reached the 20-day FLD in the last hour or hour and a half of trading. When price reaches an FLD level towards the end of the trading day, you should be very careful that it is merely an exhaustion move and that price is going to find resistance or support at the level of the FLD rather than actually pushing through it. And so for those three reasons, you should have stayed well clear of jumping into a long trade on the basis the price was bouncing out of an 80-day cycle trough. Of course, our analysis has not changed at all. We are still expecting price to form an 80-day cycle trough. I've placed these three bar counts on the chart because of the confusion that I've mentioned in previous market update videos surrounding the exact location of this 20-week or possibly 18-month cycle trough that formed at the end of February or in early March. As I've mentioned in previous market update videos, my vote goes for this trough over here on the 8th of March because that was also an important peak in gold, and I believe it was also a peak in crude oil. I stand to be corrected about that, but that date in particular, this central of the three troughs, is in my opinion the most likely position of the 20-week cycle trough or possibly 18-month cycle trough, although as discussed in last week's market update video, the possibility that that was an 18-month cycle trough is less and less likely. And so you can see this bar count over here standing today at 62 bars or 62 days measures from the trough on the 8th of March. This shorter bar count over here measures from the potential trough on the 15th of March. And this one down here at the bottom measures from the trough that has been positioned in this particular analysis. Now, the average length of an 80-day cycle is 68.2 days. And so you can work out for yourself from these bar counts over here how many days we have left to run to achieve an average length 80-day cycle. But we must bear in mind the principle of variation, which tells us that cycle wavelengths are constantly varying. And so even though the average wavelength might be 68.2 days, we will experience many variations in that wavelength for each individual wave of the cycle. But now let's switch to the NASDAQ chart. This is the one we've been looking at for several market updates, and it provides us for the reason why the markets are turning bearish because of this 54-month cycle, which is potentially pushing down into a 54-month cycle trough over here in early 2023. The reason why this analysis is more apparent in the NASDAQ is simply because the March 2020 trough did not form at a lower price, and so it is easier to position the 54-month cycle trough over here in December of 2018. This analysis, of course, as I've mentioned in previous market update videos, would have us in the third 18-month cycle, which is going to be the bearish cycle of all three of them as we come down into this 54-month cycle trough in early 2023. In last week's market update video, I mentioned the fact that in a bearish market, identification of troughs becomes more complicated because of the fact that we have so much bearish pressure and price keeps moving down into troughs on its way down to the big cycle trough towards which it is heading. I was asked in a YouTube comment, or perhaps it was by email, whether identifying peaks becomes easier in a bearish market than identifying troughs, which opens up a whole new can of worms because, of course, Hurst specified in his principle of synchronicity that the troughs of stock markets are synchronized, which means that, of course, the peaks of those markets are not synchronized. If you don't understand how peaks cannot be synchronized if troughs are synchronized, then I would encourage you to download the 10 core concepts of Hurst cycles document, which I will provide a link to below this video. The reason that Hurst stated in his principle of synchronicity that troughs are synchronized is because most of his analysis work was on US stocks. He did also analyze gold, quite extensively, as I've mentioned in previous market update videos, and he dedicated a whole section of the Hurst Cyclic Cycles course to a discussion of gold, and he discussed different potential wavelengths. As I've mentioned, I believe that gold is influenced by cycles that are synchronized at their peaks, which means that potentially we get two different kinds of instruments in the financial markets. We get instruments that are synchronized at their troughs, and we get instruments that are synchronized at their peaks. And possibly we get a third kind of hybrid instrument that is occasionally synchronized at its troughs and occasionally synchronized at its peaks. I thought it would be interesting in today's video to show you what happens if we analyze the NASDAQ, assuming that it is influenced by cycles that are synchronized at their peaks. So let's zoom all the way out and show you the results of that analysis. The results of a peak analysis are plotted at the top of the chart, as opposed to the trough analysis, which are plotted at the bottom of the chart. The first thing that I would like to point out here is that these are two separate analyses. It's what we call a dual analysis. We have the trough analysis that we've been looking at and speaking about for many, many months. But we now have a completely separate analysis at the top of the chart, an analysis that assumes that the cycles are synchronized at their peaks. And so the peaks that have been identified at the top of the chart are the result of a separate analysis. To make this point clear, let me show you this 54-month cycle over here from early 2014 through to the end of 2018. Here is the trough of that 54-month cycle, and here is the next trough. So considering the trough-based analysis, the peak of that 54-month cycle is very obviously this peak over here. That is the peak of the 54-month cycle on the basis of the trough analysis. However, if we take a look at the peak analysis, you will see that this peak over here has been phased as only a peak of 18-month magnitude. And in fact, the 54-month cycle peak is over here at this position there on the chart. That was sometime in 2015. So how does a peak-based analysis help us? Or does it help us at all? Generally speaking, a peak-based analysis of a stock market is much less reliable than a trough-based analysis. However, it does provide us with some useful information. And in Sentient Trader, we can use a tool called the ZigZag Tool to explore the relationship between the trough-based analysis and the peak-based analysis. But before we do that, let's quickly consider this peak-based analysis. As you can see, it has found a 9-year cycle. Here is the first 9-year cycle peak. Here is the next 9-year cycle peak over here in 2015. The peak that preceded the big move down in February and March of 2020 is here phased as a 54-month cycle peak, meaning that the peak that we experienced towards the end of last year was an 18-month cycle peak. Now, according to this analysis, we have the next 9-year cycle peak still looming ahead of us. That is the nest of highs for that peak over there, indicating that even though this market might be moving down into a 54-month cycle trough in early 2023, if the peak-based analysis has any validity to it, then we should look forward to a bigger or stronger peak forming towards the end of 2023 or early 2024. Now, I should point out that the peak-based analysis is not very reliable, as I've tried to say a few times today, and so I don't take that very seriously. However, considering a peak-based analysis does provide us with the useful tool of the ZigZag, so let's take a look at that. The ZigZag tool helps us to understand the shapes that the cycles are going to form in the markets. Here we have an 18-month zigzag displayed. You can see there is very little information in this line. It's simply a straight line. That's because we don't have enough information for the 18-month cycle zigzag yet. But what it is telling us is that we are in a downward move. In other words, the 18-month cycle is forcing markets to move downwards towards this trough over here, as mentioned in the beginning of 2023. But things become more interesting when we add the other cycle, zigzags. The next shorter cycle is the 40-week cycle. So here is the zigzag for the 40-week cycle. So what is a zigzag in Hurst terms, and how does it work? The first thing I should point out is that Hurst never mentioned zigzags. This is an invention of mine, and it applies the standard ZigZag tool that you'll find in many technical analysis software applications, but it adds a Hurst twist. The Hurst zigzag, as I call it, simply provides us with a 3-leg move down from a peak of a particular cycle to the trough of that same cycle. That's the first leg. This is the second leg, and this is the third leg. But what is important about these 3 legs is that they are based on the cycle analysis on the chart. In particular, the first leg will be a move down to the greatest magnitude cycle that must form a trough on the way down to the 40-week cycle trough. So in other words, it is not the 40-week cycle trough, but it is the greatest magnitude cycle that must form a trough on the way down there. In that case, this is the 20-week cycle. And as you can see, the 20-week cycle formed a trough over there at the end of February, or of course early March. And so the first move down, or the first leg of the zigzag, is a price move down from the peak down to this trough of the 20-week cycle. The second move is then a move up. Where is that move moving towards? It is moving towards the greatest magnitude cycle that must form a peak before the 40-week cycle trough towards which we are moving. I hope this makes sense. It can get a little complicated trying to explain it. But simply bear in mind that we are considering a move down from a 40-week cycle peak over here all the way down to the 40-week cycle trough over there. Following the 20-week cycle trough over here at the end of February, what is the greatest magnitude cycle that must form a peak? You'd simply look up at your analysis and you can see that it is this 20-week cycle that formed a peak over here according to the peak analysis. And so our second move is a move up from the 20-week cycle trough to the 20-week cycle peak. The final and third move is simply the move down from this peak down towards this trough over here, which is the 40-week cycle trough expected in July. That's all very well. Perhaps it doesn't look very exciting to you, but there are a few exciting things to point out. One of those is that similar to an Andrews pitchfork, we can actually generate a target on the basis of the zigzag, because the target for this move will be the result of price crossing this central move right in the middle. That generates a target over here. You can see that this target is at about the 12,000 level. The interesting thing about these zigzags is that you can add cycle upon cycle to understand greater and greater detail of the moves. Let's now add a 20-week cycle to the series of zigzags that we're building up. There it is, and now let me zoom in so that we can consider the 20-week zigzags in more detail. You can see that each leg of the 40-week zigzag consists in itself of a smaller zigzag, which is the zigzag of the 20-week cycle. So here we have leg 1, 2, and 3 of the 20-week cycle zigzag. Here is another 1, 2, 3 legs of the 20-week cycle zigzag as price moved from this 20-week cycle trough up to this 20-week cycle peak. And finally, we have the zigzag that provides us with information about what we are expecting to happen now, which is the current 20-week cycle zigzag. Here we see the first leg of the 20-week cycle zigzag moving down to this 80-day cycle trough. What is expected to happen next? We are going to get a bounce up. The zag of the zigzag, if you like, if that's what it is. It's the central move as price moves up to this 80-day cycle peak. As mentioned in last week's market update, the bounce out of this 80-day cycle trough might not be a very impressive one. Why? Because of the bearish pressure in the markets, and because of the fact that we are currently in a downward facing or a bearish 20-week cycle zigzag. Having reached this 80-day cycle peak, which is expected to occur in early to mid-June, we expect the markets to move down again in the third leg of the 20-week cycle zigzag, which will bring us down to this target over here. The exciting thing about these zigzags is that as price action unfolds, they become more and more focused in terms of the actual final target for the end of the move. You can see that the target for the end of this move is over here in about the middle of July, which is a time that I've mentioned previously for an important trough, in this case a trough of the 40-week cycle, and you can see that the actual price level over here is at about 11,800 perhaps, certainly a little below the 12,000 level. Finally, let's bring this all together by displaying the composite model line on this chart. There it is, and let me just remove the 18-month zigzag so we can see it a little more clearly. The composite model line, of course, takes all of the information from the cycle analysis and recomposes it to show us what would have happened if the only thing influencing the price action in the past were the cycles, and it then extends that cycle action into the future. You can see the composite model line is a little more bearish in terms of the formation of this 40-week cycle trough in July, but the path the price is expected to take according to the composite model line is very similar to the path indicated by these zigzags. Let's add one more element to this. Let me hide the zigzags for now, and let's hide the composite model line as well, and let me display the 18-month FLD. There it is. Now, of course, it is better to consider an 18-month FLD on a weekly chart as opposed to a daily chart, so let's do that. Here is the weekly chart of the NASDAQ, and as you can see, price came down to the 18-month cycle FLD back in January. It tapped it again over here in February, and then in March it dipped below it but bounced straight back up again, and it finally crossed it over here. Now we can generate a target on the basis of price crossing below the 18-month cycle FLD. We do that by measuring the distance from the previous peak down to the crossing point, extending an equal distance down below, and I can tell you, I've done the calculation, that gives us a target of about 11,800, which is very much in line with the kind of target that the ZigZag tool was presenting. I do hope that you found today's market update useful and interesting. We have strayed a little today from the pure Hurst approach, and I hope that I have demonstrated how the various tools that we can use to apply the Hurst cycles analysis can help us to gain insight in terms of what is expected to happen in the markets. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.